Welcome back. So this video is going to be a quick calculation, a quick thought exercise that I do before selling any stock in my taxable brokerage account, and I just wanted to share it with y'all. I think it's an interesting way to look at things, and it helps me stay away from some irrational decisions. Real quick though, if you were trading in a non-taxable account, this video is not really going to help you, so you can save yourself some time. But if you're like me and you have some investments in taxable accounts, then you should pay attention, because I think this will help you out a lot. So I'm just going to run through some hypothetical examples using the formula above to show you what I'm talking about, okay? So let's say you bought a stock for $10 a share, and then within a year, it's grown to $16 a share, so you're up 60%, okay? Does that mean that you've made 60% if you sold now? No, because of taxes, right? So we need to get an adjusted price, and that's what this formula up here is, okay? So tax rate, right now, we're just gonna put 22%. We'll dive into the what tax rate to pick in a little while, but you can see if you're taxed at 22%, then your average, or not average, your adjusted share price drops to $14.68. So in essence, you're immediately incurring an 8% loss on your investment whenever you sell it. So you got to keep that in mind. And that's something I always do before I sell something, is see, okay, make sure that I know what my immediate tax cost is going to be. Okay, and just to do that on the calculator so that you can follow, I do the current share price minus the gain that you have. So that would be 16 minus 10, because it'd be your current price minus what you bought it for, times your tax rate, which is 0.22. Okay, that's how I got the 1468. All right, you can see they match up. All right, so now let's go into a little bit of like what tax numbers to pick. Okay, so I just have here, this is from NerdWallet. I just, took a screenshot of their graphs, not graphs, their tables. But you can see here, okay, this is your federal income tax brackets if you're single, if you're married, and then this is capital gains. Okay, when you use capital gains, you're going to use the capital gains rate if you've held it for over a year. So if you bought the stock originally over a year ago, then your tax rate's going to be picked by one of these, and you're most likely going to be 15%, okay? If you're in the 20% bracket, congratulations, okay? This is based on your income. Okay, so most people are going to be 15%, so if I put 15% here, you can see that same calculation. If you held it for over a year, now it's going to, minus 6%, all right? Now, let's say you got super lucky and you held something that was a 6X. Let's say it went from $10 a share to $60 a share, and you have to pay long-term capital gains tax on it. But you can see that even though it's at 60, it would actually have to fall to $52 a share for you to break even because of the tax loss that you're going to take whenever you sell. All right, that's why Warren Buffett, well, he quotes Phil Fisher, but that's why Phil Fisher says like the best time to sell a security if you buy it is never, because you want to buy stuff that's going to continue to grow and you'll never pay taxes on it. All right. Okay, so let's talk about these income brackets a little bit. What does this mean over here on the less than 1 year? So if you sell a stock that you bought for a gain within 1 year, you're going to have to pay short-term income tax on it, which is just going to be the same as your income tax that you normally get. All right, so how do you figure out what percentage to put? Real quick, this is just federal numbers. This does not count the state. I didn't feel like putting everybody's state tax rates up there. That would have been ridiculous. So the way to read this is that if the gains is going to push your total income over this first number, then you're going to be taxed at this tax rate. If you're in between, if the gains bring you in between these two numbers. So for example, if you're making $40,000 a year and you have gains of like $20,000, those gains are going to be taxed at 22%, okay? That's selling winners, okay? Now let's talk about selling losers and benefiting from the tax loss write-off that you can get by selling a loser, okay? But I want to put a big caution out there, because I'm going to show you something that's going to make it more enticing to sell a stock that you're down on. But I think the worst thing that you could do is sell a stock just because it went down and you have a loss. Like, you have to have real reasons to sell it besides just that it went down, okay? So we're going to go over some of those, but that's the disclaimer, okay? Let's look at the current share price. Let's say you bought it at $10 a share and it dropped to $2, okay? So you have an 80% loss on something. That's terrible. And let's say it's short term, so you're taxed at 22%, all right? So what's going on? You're down 80% on this stock. If you took the loss, that would be equivalent to the stock rebounding to $3.76, okay? I don't know if that made a ton of sense, so let me try to explain it again. All right, so you lost $8 per share. You get to write off that loss if you sell the stock at a loss, and write it off compared to your other gains, okay? So that it pretty much offsets your other gains. So in a way, it's almost like you're getting money back by selling something that you're down on, because you get the tax write-off, okay? And then if I add that money back, so like here's how I did it. So $8 would be the difference times 0.22. That's $1.76. You add that to the current share price, and you see that's the $3.76. So really, the stock would have to rebound to $3.76 for you to break even from just selling it, at $2 a share, okay? That is an extreme example. You're usually not going to be down 80% on a stock that you did a lot of due diligence on, but it could happen. Things to be careful about though, okay? You bought the stock at $10 a share in this example, so you thought it was a good idea at $10 a share. If nothing about the fundamentals has changed and you believe your due diligence that you did in the original purchase, you're probably better off buying more at the share price if you think it's still worth $10 a share. Because even though you're saying if I sell it now, I'd really be selling it for $3.76, 10 is greater than $3.76, right? Okay. One other thing to note here is to be careful about wash sales. So wash sales happen whenever you cannot just sell a stock. You can't sell a stock just for the tax write-off and then buy it right back. You have to wait plus or minus 30 days, okay? 30 days before or after. It's a confusing rule and it will kill your gains if you don't pay attention for it. So make sure that you are educated about wash sales if you're trading stocks, okay? All right, so let me run through the one example where I think this is a good idea to use this strategy, okay? So let's say there are two stocks that are selling for $2 a share that you think are worth $10 a share. So you think that they're worth 5 times what they're selling for right now. You own one of them and you're sitting on this loss. So what is the right strategy in that case? The right strategy there is to sell the one that you're down on, take the tax write-off, and then put all the money in the other security. You can't sell it and buy back the same one because of the wash sale thing I just talked about, but if you can find another one that you think is also undervalued, this is where you can theoretically make more money. Mohnish Pabrai actually did this and said that he did this with Alibaba and Tencent, and I think I'll be doing a Tencent video for my next in the China-Asia series. What he did is he said, and I've explained this before, he was down on Alibaba, he didn't own any Tencent at the time, and he said, I'll sell all my Alibaba, take the tax write-off, and then throw all that money into Tencent, and that's what he did. I'll link that interview again. That was an interview Mohnish Pabrai did with Everything Money. Great interview, worth another watch. And then I'll link the website where I got these tax brackets from, and I'll link a definition to the wash sale so that you can read up on that. But anyway, that's all I got. I hope you learned something. I hope you use this to make more money. So, see you next time.